Games are won by those who focus on the playing field, not by those whose eyes are glued to the scoreboard. Those are wise words, in fact, from Warren Buffett. And if you just look at the headline of Canada's latest inflation report, I'm going to call that the scoreboard. It looks pretty good at first glance, right? Inflation dropped again. But if you dig one layer deeper, and if you take a look at the actual playing field, the core numbers are telling us a very different story. Then you take that, you pair it with the U.S. jobs report, shows rising unemployment, slowing momentum. You're going to get a mix that we really need to pay attention to. Today, that's exactly what I'm going to do. I'm going to look at what is actually happening behind these numbers. I'll explain why the real takeaway isn't quite as simple as the inflation is cooling headline. I want to start right here in Canada. In October, inflation fell to 2.2%. That is down from 2.4% in September. And that might sound like a pretty tiny little shift, 0.2 of a percentage point. That's the kind of change that most people don't even notice. But in the central bank world, that actually is progress. It brings inflation closer to the Bank of Canada's baseline projections, which they've been calling for something like a slow, steady drift down towards 2%. A major reason for the fall this month is gasoline. Gas prices dropped 9.4% over the previous year. That is more than double than the pace of deflation we saw last month. That is mostly due to an oversupplied global oil market that has kept crude prices under pressure. Cheaper gas, that means cheaper transportation overall. The transportation inflation slowed to 0.7%. That's down from a hotter 1.7% previously. Now, food inflation, that also cooled, dropped from 3.8% to 3.4%. Yes, groceries are still more expensive than they were a year ago, but the pace of the increase is at least slowing. Much of that easing comes from food preparations category. That's basically what you buy when you can't be bothered to actually cook. Think processed foods for the most part. Those rose 3.2%, which counts as a win these days. Now, happy to see that fresh vegetables, remember those? They dropped 1.4%. Shelter inflation also eased slightly, dipped from 2.6% to 2.5% year over year. Again, not a massive change, but at least directionally, it is reassuring that we are going in the right direction. Of course, anybody who pays rent is going to know that a cooling rate of increase is not the same as prices actually going down. It just means that they're going up less dramatically. So I want to look at the flip side of this too. Inflation isn't easing across the board. It never is. Cell service prices jumped 7.7%. Yes, that is the first increase in over 2 years. Several major wireless providers reportedly pushed through price hikes. Seems like telecom companies apparently felt left out. They wanted to contribute to the inflation number. Insurance costs also climbed. Mortgage insurance was up 6.8%. Car insurance was up 7.3%. These prices aren't good news, of course, but they also shouldn't be terribly surprising. Insurance, it tends to move with the broader cost structures in the economy. After several years of higher claims, we've seen in everything from car parts, home repairs, insurers have decided that it's time that consumers stepped in to help foot the bill there. Now, the Bank of Canada does not look just at headline inflation. They follow several core measures, including a trimmed mean metric that cuts off the outliers on both ends. That measure has dipped to 3%, still way above target, but it is heading at least in the right direction. Now, interestingly here, another core metric, this one excludes 8 volatile items, food, energy, mortgage interest as an example. It actually ticked up to 2.9% from 2.8%. That is also of note here, the highest reading since August of 2023. Month over month, core consumer prices rose 0.6%, which is a fairly big jump. So if I go back to where I started, the headline inflation looks not too bad here, but the underlying trend isn't entirely trouble-free yet. Not runaway, but certainly we're not at the finish line. So that is Canada. Headline inflation is cooling, core inflation is mixed, and the cell phone companies, well, they're doing what cell phone companies do. Now, I want to look south of the border because that matters too. In the United States, the unemployment rate has edged up to 4.4% in September. That's from 4.3% in August. Again, that might not sound overly dramatic, but it is the highest jobless rate since late 2021, and it exceeded what the markets were expecting. The number of unemployed Americans rose by over 200,000. At the same time, the number of employed Americans also increased by about 251,000. So we had more people working and we had more people not working. You wonder how that makes sense. It is because the labor force grew. Nearly 500,000 more people entered or re-entered the workforce during the month. That pushed labor force participation, that's measured by the participation rate, up to 62.4%. So when more people start looking for work, the unemployment rate can rise. even if more jobs are being added. That is one of the quirks that you'll find in the labor markets. Now, the broader U6 unemployment rate, this includes discouraged workers and those working part-time for economic reasons, that actually dipped to 8%. So different measures here telling slightly different stories. Again, that's pretty normal. The labor markets are certainly complicated systems. This is the last unemployment rate that we're going to get before the December Federal Reserve meeting. That, of course, is because the October jobs report will not include unemployment data. The recent government shutdown prevented data collection here. So when people say that shutdowns have a real economic cost, this is part of what they mean. Policymakers in this case are flying a little bit blind. Now, I want to look at job creation. Non-farm payrolls rose by 119,000 in September. And if you want more information on what non-farm payrolls are, I will put a link here to a video that I did recently that explains everything you need to know there. That is a pretty solid rebound from the revised 4,000 decline that we saw in August, more than double what the markets are expecting. Healthcare in this case was a big standout. They added 43,000 jobs there. Food services and drinking places add 37,000. Apparently, people are still willing to go out. On the downside, though, transportation and warehousing lost 25,000 jobs. The payroll report, by the way, was delayed also because of the government shutdown and because October release has been canceled entirely, like I mentioned. The September numbers, revisions and all, that are what the Fed is going to have to work with. So what do these numbers mean in a broader sense? Well, first of all, in Canada here, we have that cooling inflation headline. That's a positive thing. Does give the Bank of Canada some more breathing room. But again, those core measures are creeping upward, or at least they're refusing to sort of come down as quickly as the bank would like. That tells us that the last stretch of disinflation might be trickier than the first. When we look to the United States, they have that rising unemployment. You combine that with that modest job creation. That shows us a picture here of the labor market that is losing steam, not collapsing yet, but certainly it is cooling. And that's something that we don't necessarily like to see. Also, I will note here the timing of this is awkward. That Fed meeting that's scheduled to happen in December, so just next month, it will be missing that employment report. So policymakers are going to have to rely more heavily on things like partial data, older data, or more forward-looking indicators. And of course, the central bankers, they love precision. So the government shutdown isn't going to help in that regard there. The bigger picture, both countries appear to be settling into a late cycle territory right now. Doesn't guarantee a recession, of course, but it does mean that the policymakers are going to have less room for error and fewer data points to lean on. What should we take away from all of this as investors? Well, first of all, inflation progress, we have to remember, isn't always linear. We see those headline numbers here in Canada. They look encouraging, but the core inflation remains sticky. Secondly, labor markets, they can soften even when jobs are being created. We talked about that in the video today. We see that rising unemployment rate doesn't automatically mean that the economy is failing. Sometimes it just means that more people are looking for work. Now, third here, government shutdowns, they have real world consequences. There's a lot of hubbub about that. But when this essential data goes missing, the decisions that rely on that data, they get harder. The potential for policy mistakes goes up as well. Finally here, always a reminder, it's worth staying grounded, right? These economic numbers, they often look dramatic in the headlines. Most of the time, the underlying story or that field, that's one of more gradual shifts and not falling off of a cliff. I think that is what we're seeing today. As always, I would love to hear your thoughts. Let me know in the comments below. I say thank you for watching. We'll see you again in the next video.